going to get started. First and foremost, as always, thank you so much for your time and coming. For me, the most important thing is always, our time, and the fact that you'll share your time with us by coming this evening means a lot, and we really do appreciate that. What we want you to take away from tonight is really, a deeper understanding of what's happening in the world today. What do we see, the world in terms of our lens when it comes to investing, financial planning, retirement planning, and then mostly answer any questions that you might have. We've done a couple webinars, but I find with that, people are less apt to ask questions. And really, we would love for it to be interactive. We'd love, if you've got something top of mind that you're looking to have answered, that we can get that answered for you, have a discussion. If you're thinking it, wondering it, we often find others are as well. So really, please feel free to put your hand up, shout, do whatever to get our attention. We really do want to cover everything that is on your mind and make sure that you walk away from this evening feeling good for spending your time, because our time is so valuable. So just quick introductions. I think you all know me, Peter. Michael, if you haven't met him yet, he's worked with us for a number of years and been, obviously an instrumental part of the growing team. But we also have the whole team here. So if you guys can stand up, because I don't know where everyone is, I'd love to introduce you to everyone. Vedika at the front here, June, Clara, Christina, Kirsty, Anita.
Where'd Taylor go?
Taylor's back there. She was already standing. And Laura, she didn't stand up. But if you don't know Laura, that's my wife. And the team, of course, is hugely instrumental in taking care of absolutely everything that comes through our door and making sure that it happens quickly, promptly, and efficiently. And, I've, from the very beginning, never felt that this needs to be, an individual advisor show. So not the Peter show, it's not the Michael show. It's really about making sure that we have an entire team and each person brings their skill set and does what they're best at. So without all of the team that you see here tonight, we couldn't do all the great work that we do.
I just want to start off by also thanking Fidelity. We have Nate here from Fidelity. I just want to thank them for helping sponsor this event. Without them, part of this wouldn't be possible. About Continuum 2 said we are 100% third party, right? So we can really choose any of the banks or financial institutions we want, and Fidelity has to be one of the major partners that we do work with. So that's why we are very thrilled that they are able to sponsor this event for us. A little bit about kind of us Continuum 2, our advisor team, and our investment philosophy. So we work with pension-style investments that's meant to battle the good with the bad times. Many of the faces I see here today have been with us for over a decade, right? So I'm sure you've heard this speech before, you've heard this routine. Louder? Thank you very much. I've actually never been told to speak louder before. Usually it's the opposite, so I was trying to be mindful of people's ears. So as I was mentioning though, we run the pension-style investing. So essentially, the less you go down, the less you need to go up to end up beating the market, right? And for the people who have their portfolios, in 2022, you would have saw that you almost guarantee you lost less than the market did, right? And that's something we're proud of. We want to focus on the risk-adjusted rate of returns, and the only way we can do this is not taking bets or gambles with your money, right? We're going to look at well-diversified portfolios internationally, different market cycles, as well as different manager styles. We're also going to take a huge focus on education. Both Peter and myself have different financial planning and investment designations. I want to kind of take time to highlight and congratulate Peter on recently achieving his CIM designation, which I think was literally last month. Again, this is something for the portfolio management and structures of investments. And we take this lifelong student mentality, right? Our entire team is continually getting educated on new designations. And the only way we can best service you is if we're continuing to educate ourselves.
Yeah, and I think, I can't emphasize it enough. The world is obviously, as we know, continually changing, evolving, as are the markets, as, investments. What they look like 2 decades ago look completely different than they do today. So the only way that we can stay on top of making sure that we're doing the very best for all of you, our clients, is by continuing our education. And it's not just, Michael and I. Vedika's working on our Canadian securities, Taylor's working on her CIM. Like, the entire team is always focused on ongoing education. Anita's, looking at doing her CFP. So really important across the board for the entire team to have that focus on ongoing education. So I wanted to take a moment to introduce the investment team. So Clara, if you can stand up again, Taylor, and Vedika. So whether it's processing, withdrawals or deposits or new accounts being opened or rebalancing, it's the team that makes sure that that happens for us. And it's the team that makes sure that we can manage the volume that we need to and make sure that we are timely on everything that's happening. And as many of you know, the transition from Quadris to Investia was a ton of work. And not only the investment team, actually the entire team got involved in that process. And it obviously took longer than we wanted, but at the end of the day, it was the team that made sure that that happened and everything was accurate and went as smooth as we could make it go. So really important for us is that team aspect and making sure that everyone's there and everything goes as smooth as possible. So one of the things we wanted to touch on is just an update on the new office. So super excited about the move to Waterdown. We're in the drywall phase now, so you can see it definitely looks a bit of a mess. I think they've already done, the mudding and taping, so it's going to look different now than it even looks then. But it's going to be significantly different than the space that we're in now, and super excited about it. So we're going for that modern industrial look, and everything's been ordered, but obviously with materials and delays and trades, it's definitely taken much longer, but we're certainly looking forward to it.
So shifting over to more now, kind of the quantitative-based, more analytical part of the presentation. Some of the things we want to cover today is kind of what's going on year to date in 2023. I'm sure most people have heard in the headlines about the SVP bank foreclosing in the States. So we want to kind of take a dive into that, look into kind of the concept of buying gold we typically hear during recessionary periods, year-to-date performance, the housing market, as well as unemployment. And then we want to take a shift into portfolio construction, what our style is, that pension style I mentioned earlier, what exactly does that mean in reality, and then also how we build our income and retirement portfolios, right? Whether you're in retirement now or approaching it, how does that portfolio look like for you?
Among the best of America's banks for 2023, just days before it collapsed.
I am absolutely shocked at the swiftness of how the entire fiasco unfolded.
Rising interest rates limited tech companies' ability to raise money, forcing them to burn through their cash and pull money out of SVB. On March 8th, to fund client redemptions, SVB sold $21 billion worth of government bonds at a loss as they plummeted in value when interest rates climbed. Still strapped for cash, SVB announced the sale of $2.25 billion in stock, which sent its stock plummeting. A bank run ensued when too many customers tried to withdraw their money at the same time. Tech financier John Ruffalo analyzed how its collapse would affect Canada and shared his findings with Ottawa.
We were able to produce that data over 48 hours, which gave us the necessary statistics to understand that the impact to Canada was quite low.
Our national banking regulator has temporarily seized the assets of the lone branch of SVB in this country. Its business in Canada primarily lending to corporate clients, and the branch doesn't hold any commercial or individual deposits.
It was a very sobering moment for tech.
C100 is a global community of Canadians in tech. SVB was a foundational partner.
They would end up sponsoring events. They would provide funding to organizations and not-for-profits such as ours. They brought a lot of entrepreneurs together.
SVB's demise highlights the risk introduced in 2018 when then-President Donald Trump rolled back regulation put in place to ensure the financial crisis wouldn't happen again.
The legislation I'm signing today rolls back the crippling Dodd-Frank regulations that are crushing community banks and credit unions nationwide.
In the wake of SVB's implosion, bond markets are dramatically repricing, causing a rethink of the Bank of Canada's next moves. Many investors now betting that our central bank will cut rates by 1/4 percentage point at its April 12th meeting. Donna?
All right, and Gaviola in Toronto, thanks.
So to just summarize that, so I'm not sure if that's 100% clear for everyone in terms of what happened. But ultimately, if you think about a bank and it has all this money that they're sitting on, which is the depositors' money, they're like, well, we need to do something with this money. They bought bonds, and they bought longer-term bonds than they should have, basically. And then the depositors, those companies said, oh, business isn't great. We need some of that money because we have to pay for stuff. And they went to the bank and said, I need my money. And the bank got to the point where they said, oh no. They're asking for like, altogether, say $1.5 billion, and we only have available cash $1 billion. So we have this 500 million that's not available because it's locked up in these bonds. So it's not that it was gone, not that it was disappeared. If you just waited for those bonds to basically mature, they would get the money. So it's not like there was ever this danger that like the money was gone. It just wasn't available when the people needed it, and that caused the run. Like if you need your money and it's locked up and it's like, well, I needed it a month from now, but actually now I'm worried that I won't get it. I'm going to go and try to get it today. Everyone does it all at the same time, and the bank says, oh my God. So really then the backstop is the government steps in and says, that's the depositor insurance, and there's limits at 250,000 or 100,000 in Canada. They look at it and say, okay, well, we need to backstop that up to, and there's companies that had hundreds of millions at SVB Bank, because the interesting thing, it was a tech bank. So you have all these big tech companies that were using it because they wanted to support the tech bank, and essentially they had all of this money that was locked up there that then the government turned around and said, it's okay, we're going to backstop it and make sure that you have the money available and make payroll. Like think about all those companies, if they had all of their deposits with that bank and that's where they were looking to make payroll from, it becomes this spiral effect. So that's ultimately what happened. So, what we were looking to cover here is that if we look at the Canadian system versus the US system, wildly different, right? And that's a really important consideration because I can tell you a lot of the concerns, when talking to people here was like, well, what impact does this have on me? Is this going to happen in Canada? Do I have to worry about my, Canadian bank account? And we saw in 2007 and 2008, like the Canadian banking system was already recognized worldwide as the strongest financial banking system in the world. And in 8 and 9, they actually made changes to make it even stronger. So stronger regulation, make sure that they had more money as a percentage on deposit available. So really, when we look at the Canadian system, we're incredibly secure and incredibly safe. Any questions about that? Yeah.
Is there a technical difference with the credit unions in Canada versus the chartered banks in terms of the coverage for insured holdings?
No, the credit unions, as long as it qualifies for that deposit insurance, which those accounts should, so as long as it's a bank account, that qualifies for deposit insurance. So it's actually more about the type of account versus like the type of institution.
Yeah, like on any credit union, you should see kind of like this, like a little purple ribbon that says CDIC insured. And then most like First Ontario, Meridian, like all the big ones, right when you walk into a branch, they'll have like those pamphlets there showing their CDIC insured.
Yeah.
So it sounds like you think the Canadian system is secure and safe, but if you were holding something like GICs in excess of 100,000, would you recommend redistributing them to under that $100,000 cap to ensure their safety, or do you think the risk is so low that you would need to?
Yeah, so the question was if I have GICs, or I would, even extend that to accounts that are over 100,000, would I spread that across a number of banks? My answer would be no. Like, yes, I think the Canadian system is absolutely secure and safe in terms of looking at the danger of this happening. I think it's like the probability is incredibly low of like one of our main banks running into this. And what happens is like, let's say you're not with a main bank. Let's say you're with like, one of the smallest banks that we have here in Canada. So, one of the credit unions or something like that. The danger that the main banks have is that if they let one of those banks fail, is then the run happens across all banks. And that's why, in the US, they jumped on SVB right away and they're like, no, we need to backstop this immediately, because if we don't, then it just exacerbates because everyone starts running on all the banks. And the fact of the matter is like, it doesn't matter what the bank is. Like, if everyone went at the same time and said, I want my money, like, they're not going to have it. Like, that's just the way the system works, is like they've loaned it out, they've got mortgages, like all of these other things. But that's ultimately what makes the system go around. That's what makes the system work, is the fact that they do have the money extended out, making money on that. And when you look at, I've got many clients that have millions of dollars that are, with one bank. Ultimately, like the likelihood of like an RBC going, bankrupt, I would say non-existent. Like, it's too big to fail. Like, if you ever heard that term, too big to fail, it's too big to fail, because that would mean like the entire Canadian financial system would crumble if like an RBC or a BMO or something. And like, if you look at the US system, it's highly fractured. Like, so, the number of banks that they have in the US is huge, but look at, since 2001, a total of 563 US banks have failed. But their system is highly fractured. And when I say highly fractured, like, they have thousands of different banks and, different regulation by state, whereas we don't have that in Canada. Like, we have, our main banks, which are across Canada, and it's just a very different system. So you can see here, since 2001, no Canadian banks have failed. Like, not a single one. So when you look at that, like, our system is just so fundamentally different. The structure is fundamentally different than the US. I would absolutely have no worry about having all my money at one bank. Any other questions about that?
I'll take it over. So looking at, first of all, can everyone hear me now? Now I want to make sure I'm not yelling too much over it. More? We're talking higher? Wow, raising the roof, Taylor, right? We're going, okay. Cut her off on the wine. But if we look at the year-to-date performance, right? So we see the greens highlighted where it's 2% for the Canadian market. NASDAQ is 6.4. That's like the tech market in the States. S&P is 0.6. Euro and the nickel, which is more like the commodity-based stuff. And if we look across the board, we're all in the green. The markets are a little bit less than this, right? January, February started off very strong and then had a little bit of a correction since. But if we look at the kind of the different types of markets, right? In 2020, the Canadian market was the worst performing market in every major developed country. Then we flipped to 2022, where they became the number one performing. They held the downside better than any other market in the world. Now they're more in the middle of the pack. And if we follow the NASDAQ, where they're second highest, they were crippled in 2022. The tech industry had the biggest fall off. Now we're starting to see a little bit of recovery. Since the SVP, they kind of corrected a little bit more. And then the one I like to highlight the most is the S&P 500 in the euro. So many times you see people say, I'm just going to invest in a US index and call it a day, and that's my retirement fund. They're the largest economy, they've been the best for the last decade, that's all I need. Well, if we look at it, they're right now the worst of the developed countries. 2022, they were hit the hardest with the largest correction. Yeah, the last decade, they outweighed most of the countries, but past does not guarantee future. So just because they did better the last decade does not mean they're going to be the best next decade. I'm not saying they're not going to, but I wouldn't want to hedge my entire retirement on just the US alone. We look at Euro, any American newscast you'll see, they will rip apart the European markets, right? Their economy's not as strong, they're smaller, they're weaker. Meanwhile, they're kicking everybody's butt out here this year, right? And this is part of the why we want to do diversified portfolios, because we don't know who's going to be the best this year. We don't know if it's going to be Europe, we don't know if it's going to be Asia, Canada, US, the tech sector versus financial or commodities. There's no crystal ball, and if anyone who had it, they'd probably be on a yacht in Bahamas right now, not in this dinner, right? And that's why we always want to make sure that we want to diversify across different markets, different managers, because as you see here, across different developed countries, you'll see vastly different performances across the board.
And you're going to see that theme throughout the evening is really just talking about diversification. Like, that's the number one main thing, diversification, and then asset allocation. So like all of our studies, all of our research, and everything that we've been taught is talking about those are the two most important things when it comes to building portfolios. So when you look at where have the markets been, so this is year to date, and we can see right here, we're looking at what are the key points. And this is that Jerome Powell rate hike comments rattle stocks, right? So, and again, when you're looking at what's happening in the markets, a lot of it's all future priced in, but then there's some reports that come out and some commentary that come out that will shake the markets. And when we're looking at diversifying a portfolio, those are the things that we want to make sure that aren't impacting your day-to-day performance when it comes to like a long-term strategy. Like, we're not making decisions based on individual events like this that happen.
So we see the year to date, right? I'm sure most people looked at 2022, saw the drawdown, right? And it's very easy to get caught up in that lens, right? That near focus of what's right in front of you. But if we take a backwards looking approach and we look at the last 15 years, this is the Toronto Stock Exchange metric. And if you just held, that's over the 2008 recession, that's over 2020, I wouldn't even call that a full recession, how short it was, 2022, you're still over 67 or 66% up on your overall portfolio. And that's just the Toronto Stock Exchange. The Canadian market actually was probably one of the worst of the last 15 years compared to US, Europe, Asia. We looked at American markets, that's actually over 200% up. Europe, a little bit less, but say with that long-term mindset, time will tell, it will prevail, right? If you invest on a 10-year time horizon, there's a 99.9% chance throughout any 10-year segment in history, you will be positive over that timeline. So it's very easy to get caught up whether you're down 1%, 5%, 10%, to kind of have that negative kind of perception towards it. If you hold over the long term, and that's what all your portfolios are built for, they will come back up, as you will see every single time that there is a drawdown.
So, and then one of the big things, that I highlight here, gold. And the reason I highlighted gold is it blows my mind that every time we hear about gold hitting all-time highs, the commercials start, buy gold. And think about that. We've all been told, if you took any sort of business or finance or economics course, they're like, buy low, sell high. Seems pretty simple. Every time gold is hitting new highs, I see the commercial start, buy gold. Now's a great time to buy gold. It just makes no sense. So one of the things I wanted to highlight here is that when you're listening to the media and watching and reading, it's about a product. They're selling, right? They're selling you. Like when they're saying buy gold, that's a company that's trying to get new clients and they're trying to do it through the hype that's going on. The time you should have bought gold is not now when you're at $1,800, $1,900. The time you should have bought gold is pretty much any other time other than Bre-X, if we remember Bre-X. Still on an inflation-adjusted basis, it's terrible. You got killed, right? But so I started basically working in the industry in 2000 and 2001 and 2002. So I wrote my Canadian Securities course in 2000. 2002, I actually started in the industry, tech boom and tech bust. Gold back then was at $270 an ounce. That was the time to buy gold, right? Now would you do that? Would you dump all your money in there? But that's, when they're trying to sell you on this is what you need to do to make money. Again, they're selling a product, they're selling their service. That's not, a proper portfolio construction.
Yeah, a lot of time gold is, you always hear during recessionary times, right? Oh, it's a hedge against the markets. When your stocks are down, gold's going to prevail. In 2008, it held its value. So if you factor for inflation, it technically still lost, didn't get you any positive return. And if you look at last year, it was down 6.4%. That was less than the Canadian stock market, right? So there is, as much as you'll see that history, people always say, during recession, buy gold. It will hold when your markets are down. The gold will follow any business cycle, just like real estate will, just like stocks will, any other commodity. There's no winner forever or in any specific time. It's always just a different business cycle. And if we're looking at now moving towards the 2023 outlook, we actually touched on Deloitte's report in our last webinar. So I kind of want to take the time to kind of go over their points from January and see, well, now we're almost done the first quarter, what's really kind of coming to light. If we look at the housing market impact, Ontario and BC, which you'll see even heavier on the next slide, have definitely been hit the hardest, just like their reports are showing. Close to 20% corrections, 40% drop-offs on even sale quantities, right? So a huge drop-off on the housing market. And then we'll also see the job losses report, right? They were expected to be low, and just as they are, if you look at Indeed, LinkedIn, everyone's still hiring. Companies don't hire if their financial statements don't look good or their future outlooks don't look good. We see the layoffs in the tech sector, and that's because they just were hiring at Lynn. They took advantage of low interest rates for almost 20 years, and they just were paying people $200,000 plus to do almost nothing, right? We saw what Elon Musk did with Twitter, right? Every other industry, if we see it, they're still hiring, and that's definitely a sign that they see promise to come. History shows, this is a funny one, because history shows risk of the best time to invest is halfway through a recession. Obvious point they bring out, right at the bottom, invest. Of course, no one can time that. They do believe that we will hit a recession. It's not as doom and gloom as people are projecting. the news outlets will always show that Stuart Little, sky's falling, but never really is that doom and gloom, right? We are projected to see a mild turnaround. This report came out in December for the 2023 outlook. We saw January take off with a boom, right? The steam's kind of come off a little bit, but the market will be subject to new news. They have everything priced out. So right now they expect that hopefully with the financial kind of run in America, that well, hopefully Jerome Powell will bring the interest rates down, or at least maintain it. So at the chart earlier, you see that the market went down after he said we still might bring the market up. We still might rise the interest rates. If we start to see where they said 2024, if we start seeing that interest rates are cutting earlier, it will send a positive sentiment to the market actually increasing from there. So there's certain things priced into market, and then whatever new information comes out from that, if it agrees with it or is preferred, it will send the market up. If it's contradictory or negative towards what the expectation is, that's what will cause the markets to go down, at least based on efficient market hypothesis. And then again, they're projecting a 2024 strong year with 2025 even stronger to come. Again, that's just their reports. Every analysis, every economist is going to have their own reports. They're mostly following the same rough guideline. Deloitte's one of the biggest reports to come out with it. But again, this is just their projection and evaluation. It's not set in stone what's actually going to happen. All we know that is 2022, we had a down market, and what goes down always comes back up.
So Canadian housing, this is always something that's top of mind for me. And, you know, I've been saying now for years, if it's unsustainable, it's just unsustainable. And like we're seeing that come to fruition. I mean, there's just no question about it. You can't have, you know, numbers so offside in the sense of like, you know, it takes 40% of a household income or 50% of a household income just to carry the house that you want to buy. Like there's just no way that can continue. And so, you know, we're starting to see that. And, you know, one of the interesting things that we talked about in our last market update was when you look at the impact that rising interest rates have, to feel the full effect, you're looking at 18 to 24 months. We're still nowhere near 18 to 24 months since those increases have started. So although we've already seen a pullback and it's already been significant, my prediction, and I'm not an economist, is like that's going to continue to get worse. So I think either we see it continue to get worse or they need to react and lower those interest rates sooner because like they're just going to bury people. Like there's so many people that are going to have their mortgages come up and there's no way they can afford it. Like it's just not going to happen. And you know, I have clients where their kids are in that position right now.
Yeah, we've seen a lot of times where there's a lot of reports showing that if you bought a house at $500,000, the interest rate's at 2% versus currently at 6.5%, even if the house went from $650 down to $500, your mortgage payment actually would still be more. So even though the prices of houses come down, the interest rates have actually caused an even worse housing market than we were in the initial bubble of prices.
Yeah, so like, tell me how this is sustainable. A 28% increase in mortgage payments for the same mortgage, right? So if you look at those increases, 2020, 2021, 2022, look at where 2023 started, $2,500, right, at 6.65%. It's massive. Like it's absolutely massive difference. So, I mean, you're talking about, there's people that have $1,000, $2,000, $3,000 a month increase in their mortgage payment. Like that's not sustainable.
Just to make, if anyone knows anyone who's going through a housing market crisis right now, just to make them feel better about themselves, please use this story. I bought a pre-build in May and I don't take it until October. So that should hopefully make them feel better about themselves. The Canadian market's going to follow US a little bit. US is definitely more fragile and subject to big crashes, as we saw in 2008, where Canada held really, really strong actually. They were the leading real estate market out of the recession. But if we look at affordability, it's actually worse than it was in 08, right? So if we look at the last peak, where they had almost a 50% correction, the US is worse. In the world, as much as we hate to admit it, it follows America, right? So if we're looking at them with having an affordability issue, we might see some ripple effects in other economies. It's not a direct correlation. Just because they might crash doesn't mean we will, but our housing market is actually in a higher bubble than the Americas is, and we already see the affordability issue in America.
Yeah, and the interesting thing is like, I'm not so much lately, but I would say even 5 years ago, there would still be people that say like, oh, those Americans, they're terrible with money. They're actually not. They're way better than Canadians. And the reason they're way better than Canadians is because they got sideswiped in 07 and 08. Absolutely sideswiped. And that was like the slap on the wrist, the slap on the hand. They basically righted their ships. That didn't happen to Canadians. So like in 2007, 2008, our housing did not get crushed like theirs did. So guess what? A lot of Canadians didn't learn their lesson. And they kept going back to the house, back to the mortgage, taking more out, more debt, and ratcheting that up as they did renovations, they did improvements, they bought bigger houses. And I mean, this could be like, you know, our time of reckoning when it comes to what's going to happen to our housing market.
And then continuing on to the unemployment, or another key factor that we're seeing in the media is unemployment rates are rising. It's mainly the tech industry, right? Like I think we talked about this earlier, so I don't want to spend too much time on the slide. We see the tech industry laying out. They were the biggest boom. Again, everything's on a cycle. So the tech, they boom the most. Interest rates are crushing them essentially, so they need to bring down their employees, and they're probably just going to hire the same employees back at a lower premium. That's essentially the way how you get out of a lot of HR rules, right, Christina? I'm not the HR guy. I'm just the HR problem. But looking at the millennial debt crisis, right, this is the largest generation right now, and this is where we see the major issues in affordability. So millennials in your room. So we pretty much see anyone's grandparent or parent, you hear them say, well, I bought my first house at 20 years old. Well, and they say, and I made significantly less income. It is true. The income now is significantly higher than it was even looking back at 99, not even taking into fact when they bought their house in 1940. But their mortgage average is 117 versus 218,000 nowadays. So if we look at it, people's after-tax income, their mortgage is over 200% of their income. Where back in just 1999, it was 125%. So that means in this 20-year span, the debt-to-income ratio has more than doubled. So yeah, incomes have gone up on the rise, but has not nearly kept up with the housing market increases. The housing market in the last 5 years alone has doubled after factoring inflation. So inflation's been 7% last year, it was more like 2 to 3 the other 5 years. It's actually doubled above that inflationary amount. And what are some of the main causes causing this millennial debt crisis, right? The first one is student debt loans. But 1/3 of millennials actually carry student debt around $17,000, right? Again, one thing that's also beat inflation has been, unfortunately, tuition prices. That's another thing that's already doubled since the 90s, and it's actually projected to go up another 30% in the next 5 years, which is just going to cripple the new generation even more. The second thing is which we've already beat it like a drum, is the increasing cost of home ownership, right? It's FOMO. People were worried that they had to buy a house, they were never going to be able to afford one, and to stop the bleeding, they just participated in that fear of missing out. The next one is the millennial wealth gap. This is probably the largest wealth gap we've seen since before the baby boomer generation, which was the lost generation. And that's 10% of millennials hold 55% of wealth in that generation, right? So essentially the rich keep getting richer and the poor keep getting poorer, and it becomes more and more difficult for them to keep up. These millennials are upwards of 40 years old now, right? And as they're in the mid-20s all the way to the 40 years old, and it just gets harder and harder for them to keep up. And that wage discrepancy is really what's causing the huge debt issue. And the last one, which was, when I read the stat, I couldn't believe it, maybe just my biased financial mind, but 87% of millennials holds credit card debt. And this is, if anyone knows, the worst debt to hold, almost. I know those quick cash ones are significantly worse, but from a financial institution, the worst debt to have is credit card debt, and the fact that 87% of millennials are holding this, that means they can't afford to keep their cost of living because they like to live the high life. They can't afford their mortgage premiums, and they're going to line of credit. And the last debt, they're still going to credit card debt. So they have student debt, they have mortgage debts, they have line of credits, and it's trickling to the worst point where they have credit card debts. Again, inflation's getting worse, and they can't keep up with their lifestyle, and it's causing worse and worse debts to come along. And again, if you're in that bottom 45%, it's just going to get worse and worse for them if they can't find a way to either cut lifestyle or pay down those debts.
So when we look here and we look at, again, what's happening in the economy, what's happening in the world, because all of these things we're hearing about. And when we're looking at building portfolios, like, these are not the things that go into building a portfolio, but they're the things that you hear on the media. They're the things that will cause impact on the markets. Ultimately, does that make an impact to your long-term ability to retire? No, it doesn't. But these are the sort of things that when you're looking at what's happening in the world, like the labor challenges that are happening, and the reason we bring this up is because if all of these companies are having a hard time filling the spots and getting people to work, then to me that says like the companies must be doing okay. Like they're not laying people off, they're actually looking for hiring, and you don't have enough people to work. So you actually have an economy that's actually still reasonably producing. And the more we get into 2023, I've heard and seen reports where actually they're feeling good about, we could actually already be into that recession and on a possible trajectory to be coming out of it already.
Shifting away from the housing market portion now and the unemployment, we're looking at how we build portfolios. So we actually got this chart from Fidelity. Thank you, Nate. And it shows kind of what the portfolio management team actually goes into building the portfolio. So we don't take a deep dive into this, but we see the different asset classes, right? Well, there's different countries, different market, different types of bonds. They actually factor every single subcategory, how much they overweight it or underweight it. So how much they like it versus dislike it, to keep it in simple terms. So the do-it-yourself investor who holds 10 stocks in a portfolio, maybe some cash, and they say they're golden, maybe they throw an index fund in there for the low cost, they're missing the whole part of this is shifted constantly. They're getting new information every day, and every quarter we'll get new charts like this, right? We see what they're overweight, underweight. They look at it not just a macro view, so like kind of the big picture global, they're looking also at a micro, right? Every single individual company, every single sector, every single country, they're shifting these weights constantly, right? We don't want to hold a standalone US fund where if the US is falling apart, well, they can't do anything about it. You keep it from a global perspective with a hybrid approach. If they see the states falling apart, they can move to Canada or Europe, or other way around, US starts to boom, they can move money into it. We saw 2020, Canada, I think most global portfolios had maybe 2% Canadian. By 2022, they had close to 10%. That's a huge shift in billions of fundings that are going just within that 2-year span. And now we're starting to see money actually shift away from it, right? We see Canada at a negative 5% shift away. That means they had their swing, the pendulum swinging somewhere else. This is just part of the very in-depth process that these portfolio management teams at these fund companies and banks go into picking their individual funds.
And the reason I thought this was critically important to share with you is, so if you look at that CIM designation, it actually talks about being a portfolio manager in discretionary investing, which means like technically I should be able to do this and make these calls. But when I look at the work that we do, and I think the value proposition that we bring, it's about being honest and direct about what value do we bring, what's our skill set. And when I look at a lot of other advisors out there and people trying to do it on their own, they think they can do this. And I mean, if you look at this and the breakdown that they do and the projections and the calls that they're making, like I can tell you, I don't care if the broker's downtown Toronto, if they're telling you they can do this, they can't. Like there's just no way that if they're meeting with clients and they're on the golf course and they're having lunch, that they're doing even 10% of what they need to be doing. Like the teams that do this, the level of education that they have and the time that they're spending doing this is literally all day, every day. All day, every day. So the guy that's not doing this all day, every day, that's telling you that they're doing it, like they're just not. And if you're trying to do it on your own, like just be honest and truthful, like there's just no way you can make these kind of calls and build a proper, well-diversified portfolio that's gonna stand the test of time, that's gonna make it through good times and bad times, growth times and value times, the 08s and the 02s and the 2020s. It's really about let the people do what they're trained and skilled to do, and let us do what we're trained and skilled to do, which is that big picture, that fundamental view, and let us do the analysis of like who's the managers and who's the portfolio managers and the teams and the companies that we know that we can trust and put faith in with the Morningstar analysis, which is what we'll show you, the work that we go through, that when we're building a portfolio, that's where our job comes in, is we're basically looking at the managers and looking all the stats and all the data, which is absolutely available across the board for each and every single one of them, that we can do that analysis. And that's one of the biggest things, is being able to do the analysis of like, are they delivering on their value proposition? Are they delivering on the type of portfolio that they're building? And then doing that peer-to-peer comparison, that if it's a growth manager versus a growth manager, how do they compare? Because if you're comparing a conservative portfolio to a growth portfolio, that's completely apples and oranges. So if you compare a conservative portfolio and you look at a market correction time, you're going to say, well, this portfolio is way better. And then you look at the growth portfolio and you look at that growth portfolio in 2019 and you'll say, well, this is the one I should have because like, look at the returns that they got. But then when you come to a correction time, everything flips upside down. So when you're doing that analysis is critically important. It's not as simple as like looking at today and saying like, how did they perform? Because it's how did they perform in the market that they're in compared to the peers that they're with. And that's when we use Morningstar and we look at the deeper analysis. So this is a balanced portfolio over a growth portfolio. So if you were in it for the long term, you can see the balance did 22,000 and the growth made 25,000 over the same time period. You can see the rates of return and how they performed. And really it's about understanding volatility. And it's about understanding the time period that you went through. Really looking at that deep dive of what fundamentally makes up that portfolio and what was built into it that got those rates of return. And then we start talking about risk-adjusted rates of return. And that's a critically important piece. And I can tell you that for a number of the clients that we come to that are coming from an external advisor, the risk-adjusted rate of return is often something that's overlooked. They haven't understood how much risk they're taking on to get the return they achieved, which if you're 20, 30, even 40, it's kind of irrelevant. Who cares? Because as long as you're in it for another 20 or 30 years and you're fine with that ride, you're going to be rewarded with it just for staying in. But you start getting into your 50s and 60s and you're trying to adjust the ship for a retirement plan, that's a wildly different portfolio and even more different if we start taking income out. So when we start looking at sort of the deeper analysis of asset allocation, and I already mentioned asset allocation, I don't care where you read every study, number one determining factor of your rate of return. Not the stock you pick, not the manager it is, asset allocation. And that is, do I hold what percentage of stocks, what percentage of bonds? So that's the list that you can see there. What percentage of cash, US equity, that's my asset allocation. So if you get that right, the percentage is like 80% of your returns is determined by asset allocation. It's huge. So many people and advisors ignore that critically important piece.
This is looking at one of the funds we have a major holding in, so a lot of you may actually have assets in this fund. It's the Fidelity Growth Portfolio. As seen on the top left there, at least from my perspective, it's a 5-star rated fund. On Morningstar, again, this is a 100% third-party analysis, not our unbiased fudging the numbers up. It's a world-class software. It's rated out of 5 stars, and it's a 5-star rated fund. We will only recommend 5 and maybe sometimes 4-star rated funds. And if we look at the quartile rank, which I want to emphasize on, from 2013 all the way to present, the fund was in first or at worst second quartile every single time, right? To be the number one consistently, there's not one fund out there that's always that number one, but what we want to see is consistency, right? We don't want to have number one, then number 4, 3, and all over the map. If this is your retirement, we want to be able to have long-term sustainable returns. So when we're looking at this quartile rank, always being in the top 2 quartile is something that's really important to us because we want consistency, right? We want to have the top class funds. Every 6 months, it's not ideal to move in and out, try to pick a winner. We want to have consistency for the long term. And again, this is just one of our major funds, but we take this breakdown into every single fund, and we have hundreds on the watch list that we look into. We meet our specs, and we look at not just today's returns, how they're looking today, but how they have been consistent over decades.
And let me briefly touch on quartile ranking. It's actually critically important, and a lot of advisors, again, and people have no idea what quartile ranking is, how it works. So ultimately, there's 4 quartiles if you're in the top 25%, top 50%, bottom 25%, or bottom 50%. So those are the quartiles. So if you're in the second quartile here, what that's telling us is that in this time frame, year to date, it was among basically above 50%, but below the top 25% amongst its peers. And that's critically important. So when you look at a growth portfolio, they compared it to all other growth portfolios, which is 1,186 in the growth portfolio range. So when you look at that, if you're in the first quartile for 2022, even though it did minus 9%, it actually was the top 25%, actually 24 percentile of rates of return for that time period. So when you're in looking at different investments and doing the analysis, first and second quartile is where you want to be. Like, I just want to be among the top 25% or at the very worst top 50% of like managers in a like investment. And if I'm in the third quartile or worse, fourth quartile, we got to get out. And the we got to get out is if you see that for like 1 quarter or 2 quarters, or maybe even a year. It's not like, oh my God, we got to jump ship now, because what's happening in the world, what's happening in the economy. It could be a growth manager in a time where value prevails. You don't dump that, because it should be part of an overall portfolio construction where you have that built into the diversification. But it's definitely what we look for, and it's definitely what we watch, is that quartile ranking. And that is one of the best determining factors of how did that investment do compared to like investments, like managers. And it's interesting, when we look at what we're building here, you know, what no one can tell you is when is the work. My mother's calling. Busy, Mom. No one can tell you the best time to buy or the worst time to buy, but we can absolutely say, like, is this a good time to be cashing out and, you know, building an income portfolio? Now's not the time. The interesting thing is that actually we look at 2019 and 2020, and there's actually clients here tonight where I sat down and had, it was not a hard conversation, but it was a conversation like, hey, we need to build this. So we're going to take a big chunk of money and we're going to buy GICs and cash, and we're going to give you 3 years of guaranteed income. Peter, why are we doing that? Like, the markets are doing great. We're going to lose out on returns. I said, listen, the one thing I can tell you is I don't know if now's the best time to do it, but we know what correction is going to come. The question is when. No one knows when, but if we build this structure, we're going to be in a position that we can weather that storm. And I can tell you 2019, it's not because I'm a genius, just worked out to be like, wow, that was like really good timing, because we followed the regular process. So right now, we're not taking big chunks of money and moving them to cash. And we look at it all the time, and Vedika and Taylor, Claire will come to me and say, okay, like, you know, are we going to do this? No, we're going to hold off. And we have clients that, like, you know, from 2020, 21, 22, 23, like, we have this cash reserve that we can basically live off of, and you have no volatility that's happening with those withdrawals. And that's critically important, especially when you're getting into retirement in a market correction time. And there's all kinds of studies that show people that burn through like 30% of their portfolio early on because it was a market correction and they had no idea that they did it. They just figured, I need to live on 80 grand a year, so I'm going to take 80 grand out of my investments. Guess what? If your investments are down 20% and you take 80,000 out, you took a big chunk out that you didn't even realize the impact that was going to have long term. So what this structure does is really look at that. How do we build consistent, reliable income that's not changing with the markets, that doesn't have that volatility, but can still participate long term? And that's the other piece, is like, you know, if we think 40 years ago is like buy bonds and retire and you're going to be fine. No, that doesn't work either, because you're not getting the returns you need to live off of and also take care of inflation. So this structure was built to get the long-term rates of return that you need, to have the midterm that we can then balance into the cash as we need it, and then have the cash to give you that monthly cash flow for sustainable lifestyle. So here you have 3 years of guaranteed income. You never need to worry what's going to happen. Any questions? We've covered a lot of content. Any questions about what we've covered so far, this in particular?
Peter, what's your perspective about crypto?
So the question is perspective about crypto. It's a great question because I actually followed it very closely, very early on. I have a huge interest in crypto myself, just because I'm a gadget geek and a technology guy. I'm like 100% securely on the fence with crypto. And I'll tell you why. So like very early on, like I went to like a lot of like, they had PhDs talking about crypto and like tech guys talking about crypto, and they would try to use analogies like gold. It's like gold. And I said, well, listen, no, it's not anything like gold. Because gold, there's a finite amount of gold. It's a resource that's in the ground. You pull it out, you have gold. Crypto, and the analogy that they're trying to use is like, basically when you look at Bitcoin, it's like, okay, there's a finite number of Bitcoin, for example, but guess what? They come out with Ethereum and they come out with Dogecoin. So like that's nothing like gold. There's no gold plus and gold extra and gold wonderful. Like, so the thing is, when I look at all the things that they say about crypto being our savior, is all the things all our governments want nothing to do with crypto. It's hidden, it's, you know, untraceable. Like, how do you tax it? It's unregulated. And look at all the thefts that happened to crypto. Like, entire crypto markets got wiped out. Like, billions of dollars got lost. Who's going to put faith in that? And then finally, when you look at crypto, like 1 week I can get my hair cut with 1 Bitcoin, and the next week I can buy a Jag. Like, seriously, that's the craziness. And then like I can buy a Tesla, but then I can't buy a Tesla. How's that a store of value? A store of value needs to store value. Like, it's hilarious that they even call it a store of value because there's no storing of that value. It's just this massive fluctuations up and down, right? So when you look at exchange, like using it like cash, why would I give you 1 Bitcoin today if it's 20,000, if tomorrow it could be 60,000? Like, why would I buy that car today? Like, today it would take me 3 coins to get a Jag, and tomorrow it could be 1 coin. So who would ever do that? So I think the future, again, my personal opinion, I'm not an economist, I'm not an expert in this, but if you look at it, if there's going to be a future that includes crypto, it's going to be government regulated, government run, and like the US Reserve is going to come out with their own US crypto. And I said this like 10 years ago, because I'm like, if they can't regulate it, they want nothing to do with it, right? And you look at who's using crypto, it's terrorists, it's drug lords, it's like all the people that you think would use a hidden underground currency that no one can track or watch. So that's my rant on crypto. I don't know if that answered your question, Hendrik, but yeah, I'm passionate.
So again, final tips, and then again, we will leave it back open to another question period if there is it. Again, we're looking at one for 2022 state contributions. Just to keep in mind, financial institutions do not need to report to CRA until March 31st. And you bet they're waiting to the last dang day to report those numbers. So when you go on My CRA and see your state contribution room, it's actually going to be inaccurate right now. So we typically wait until April, probably into May if you have to, because if they don't report it to March 31st, that means all contributions you did in 2022 are not showing on your CRA yet. So it might show $12,000 a room, but if you did $6,000 last year, you only have $6,000. So instead of playing that guessing game, it may be best just to wait till April to wait for top up, unless you already know 100% certainty. I only have the new room of 6,500. I already maxed out last year. Also, the second week of March, which is already behind us, Investio will send out reports for anyone who has non-registered investments with us in F class, but it will only go out if you have e-delivery. So if you did uncheck the e-delivery and have newsletters, you will not actually get that. So again, if you have not received the e-doc or you aren't registered for the e-delivery, please let our team know. They've been introduced and they can get you that report.
So that's our presentation for the evening. Hopefully we gave you some insights and some things to think about and ponder. Absolutely happy to take any and all questions that you might have, whether it's the economy related, markets related, investment related, portfolio construction. Like I said, I mean, I want you to walk away with a feeling of it was worth your time to come, not just a great meal, but yeah, please feel free to ask away. Frank, yeah.
Question, based on everything you presented and talked about, what would you say the Russian war has contributed to everything that you talked about?
Sorry, I didn't hear the last part.
What has the Russian war contributed to all of this?
Oh, yeah, good question. So the question was, what has the Russian war contributed to all of this? That is an easy answer. Uncertainty is really what it's added to the mix, is a ton of uncertainty in terms of like, what does this mean to the rest of the world? So it's interesting, actually, when you look at the statistics of what a war does to economies, typically you see growth following the war. And what happens is it's the rebuild, it's the funding, it's everything that needs to go into actually having the war that causes growth to follow. When you add that on top of everything that happened with COVID and the inflation that we've seen, and that's the hardest thing that comes to an economist's job of predicting the future. And I'll never forget, I took stats, like second year stats was first year, and I basically slept through it and got like an 86%. I'm like, stats is easy. So I'm gonna take like third year stats, like it'll be easy again. And I did that and I got crushed. And what crushed me in stats third year was this called regression analysis. So regression analysis is basically if we have an infinite number of things that can impact the economy, for example, how do we mathematically calculate what impact that's going to have? And it's all of these variables, we don't know what's going to happen. And that's the world that we live in, but it's been exacerbated. And one of the things I'll tell you that is when I look at what's happening in the world today, my back always gets up when it's like, well, this time is different because very few times it's actually different, is we see the same sort of pattern happening over and over. But what I can tell you that I think truly is different in the world is the rate of change. Things are happening and changing so quickly around the world, and I think that has a lot to do with technology, and I think we are a more global world, if that makes any sense, is that when you look at, like I said, the war, COVID, inflation, housing, unemployment, or employment, like all of those things together creates a massive amount of uncertainty. And that really puts markets into turmoil because they're making their call on what they think is going to happen. And that's another really important thing to understand about markets is they're pricing in the future. A lot of people think they're pricing in today. No, they've already priced in what they think is going to happen. Like that's the price you're seeing today. So I hope that answers your question. It's definitely a ton of uncertainty in like how long is this going to last and what does the future look like and what's the rebuild look like. But if we look historically, it's good for markets. Unfortunately, that's what happens with war. It's good for markets.
The reason we got out of the Great Depression was actually World War II, right? No one was working. I'm not going to try to justify World War II as good by any way at all, but it forced people to go to work, right? Men went to war, women for the first time and went to work, and they worked in the factories, and it caused actually larger output. And we see that throughout history with a lot of major wars.
Any other questions? We got them all?
Yeah, right.
Yeah, Rob.
One more question.
Yeah, please.
I'm not even,
No, it's good.
I'm a newbie.
Yeah.
The shift from the oil economy to whatever that new economy will be,
Yeah.
electrification. Is there investment opportunities that are like 10 years out that is not going to return the investment today that you can see on the horizon?
I have one. Hydrogen is a huge one. I've seen reports where
Talk way louder.
Pardon?
Talk way louder.
Oh, I'll take the mic back. But sorry, I'm significantly jet lagged with my throat as well. So hydrogen is something that, especially a couple of years ago, I saw huge reports coming out. Actually, one of my uncles called me saying, "Can I put all my money into this?" Because reports that hydrogen is the future. It's how they mine everything out of it. And if you look at any hydrogen stock over the last few years, it's been plummeted by 70%. So in 10 years, it may be your number one winner, but are you willing to take 70% losses, 80% losses, maybe completely wipe it out? And if you're looking for hydrogen, are you buying an index? Is there an index? Which stock, which company will survive it, right? So there are definitely companies that may be the future, but to wait to see it coming, one, is incredibly difficult, and two, even if you see it coming, it may be 10, 20, 30 years to even manifest.
Yeah, and I think so the question was actually about, if we look at today we're an oil economy and like what does the future hold? And I think the big thing about that is the timing. Even if you could say with like what, and I think that's where I said kind of on the fence with Bitcoin or crypto is like, could it be the future? Maybe, but is it 5 years from now or like 50 or 80 years from now? And I think that's the challenge that we have with oil, right? And I think if you ask people like, before COVID happened and before like this massive like, oh my God, how do we, fuel if we look at Germany, right? It's like, holy cow, like you talk about issues is like, we can't heat our homes through winter. What are we going to do? So I think before that, if you ask people how long is oil going to be around, I think there would have been a lot of people that confidently said like it's going to be pretty short term. Like we have all these other resources and available and green energy, and you look at electrification of vehicles. Like when you look at the network and the infrastructure and everything that goes into that switch, like I think you're decades away. Yeah.
Concern about what happened globally back to Russia and the war and the agreement with Russia, China, Iran, Saudi Arabia. Aren't we concerned about, shouldn't we be concerned about our market in here and how we can invest? Can we read it through it? Because the plan is to affect the United States, and we know China pulling money out of the United States to demolish it. So we should be concerned here or not?
Yeah. What they're looking to do is, make a deal that really at the end of the day uses the Chinese dollar to transact oil. I think that would actually have a huge impact to the US, no question about it. And should we be concerned, and how does that impact our investments? I think all it does is reinforce even more diversification. Like at the end of the day, you're never going to make a call of what's confidently going to happen and the time frame it's going to happen on. And long term, what I can tell you, like you look at the Roman Empire, nothing lasts forever, right? But how long? That's the question. So if oil stopped transacting in US dollars and started transacting, is it the Chinese, what's the
yuan?
Yuan? Yeah, the yuan. I mean, that would have a massive impact to US. US is our largest trading partner, so if US went down because of it, or not down in terms of like, bankrupt, but just their productivity and all of that. But what I can tell you is that actually if you look at the stats of where US is today, it's still staggering. Like you have the US, like their GDP is here. It's like China, Germany, it's like the top 3 to equal US. So they're still like so far ahead in terms of an economy that I think the future for that, Khalil, is still like years away. Now, when you look at their appetite to do that, and like that's 50, they said that, that's 50% of the population, would they love for that to happen? But guess what? There's so many other economies that would be like, no, we don't want that to happen because of all the other implications that it would have. So I don't think the day's here yet, but obviously it's China's maneuvering themselves to start setting that up. Is it going to happen in our lifetime? To be honest, I would be surprised. Like the US being like, for 3 countries you need to put those 3 countries together just to get to the US GDP, that's huge. Like that's huge. So until there's more equality in those numbers, I think we're still safe from anything that massive happening. Any other questions? No. Thank you, everyone. I really appreciate it. And if you have questions after, feel free to come by or drop an email, and hope you enjoy dinner. Yeah, and thank you again.